which, every $4,000 in gold price, there's about $1 trillion in assets in the Treasury, assuming that the 1953 count is still correct. I think that to simplify, as you see interest rates lower, yes, that increases money supply and increases money flow, but that money disproportionately flows to the wealthy first because they have access to that cheap credit to invest in things or worse, behave in risky things like leveraged assets. And when I was looking at the monetary system and looking at the policies that the U.S. government was deploying against these asset classes, well, I think we're seeing the final gasp of the fiat money system. And I think that the push in precious metals really is indicative of the risk factors in the US dollar. And, there's no real way that the Fed can, or that the US government can get out of this by usual means. Every politician promises the star, the moons, the sea, everything under the sun. And so I think you're seeing a reflection of that because we're talking about lowering rates. President Trump's putting a lot of pressure on the Fed to lower rates. Just yesterday, he was sort of insinuating that David Hassett would be the new possible Fed chairman after Jerome Powell finishes his term next year. And so when you look at the factors of the M2 money supply, the total amount of money that's out there, and the tendency of the Fed to print money, I think that it's pretty obvious that they will continue to print money at probably volumes that we have not seen. Yes, exactly. We will probably see an unprecedented money printing episode when you also look at the fact that, there's a lot of pro sort of minimizing income tax. There's some little rumors about Trump talking about no income tax. There's, the bill is already passed. The big beautiful bill, as they call it, is already passed, which reduces corporate income taxes further. And so I think that when you look at the cost of precious metals, it's just reflective of that money supply increasing. And as we go into what might be the Federal Reserve's final maneuver, which is to print us into an oblivion type of category, which does revalue the gold and pushes it up, which, every $4,000 in gold price, there's about $1 trillion in assets in the Treasury, assuming that the 1953 count is still correct.
To many, lower interest rates sound like relief. Cheaper loans, easier mortgages, growing markets. But the mechanics are more complex. When rates drop, liquidity floods the financial system. Those with access to credit, corporations, institutions, asset holders, deploy it quickly into stocks, real estate, and speculative markets. The result? Asset inflation. Wealth expands on paper, but consumer prices often follow. Housing becomes less affordable, groceries more expensive, and savings lose value over time. Inflation acts as a silent transfer of purchasing power. For households without significant investments, monetary easing can feel less like opportunity and more like erosion of financial stability.
Yeah, I think those of us who hold assets obviously see the upside, but the average person is not. So we see the upside in terms of this is going to drive these asset prices up because we're holding our wealth inside of these vessels. But if
So
you are
you're
not
talking about like stocks, the stock market, the crypto market.
Yeah, I'm talking in general, like assets are getting inflated by the access to cheap money, which is why you see the wealth inequality, right? So the average person that isn't holding their assets in stocks or inside of gold or crypto assets, we're going to see this manifest as inflation, which means everyday goods continue to increase in price, and exacerbated by tariff policies, exacerbated by potential shifts in tax policy towards consumption rather than income if they go down that route. And you will also see the continued issue with home prices. And really, I look at home prices as a reflection for the most part, on average, when you aggregate it as a problem related to the inflation itself, as you continue to print more money. And I think that we're at the sort of limits of that system because the average person cannot afford a home in a lot of markets, and or it's a worse purchasing decision. And that will be, if you think a 50-year mortgage is a good idea, you need to look at an amortization schedule for a 30-year mortgage. You're realizing that for the first 10, you're not really paying anything back on that asset. So I think we're the caution for anybody who isn't holding any dollars that they earn or isn't able to scrape at least a little bit of savings into the asset class that they believe in, they will see unprecedented inflation, and we're going to see costs everywhere increase. And maybe that's the goal. Maybe the goal is no ownership. I don't know. I'm not really driving into that, but there's a world where we own less stuff, and we can't afford to get back into it. And the BlackRocks of the world purchase, or the Berkshire Hathaways for that matter, purchase all of the viable single-family homes in the country, and that further makes the issue a problem. So I think that, to simplify, as you see interest rates lower, yes, that increases money supply and increases money flow, but that money disproportionately flows to the wealthy first because they have access to that cheap credit to invest in things, or worse, behave in risky things like leveraged assets. And the rest of us see that manifest as prices going up everywhere, and the tariffs don't help that reality.
In 1971, President Richard Nixon ended the dollar's convertibility into gold, closing the gold window and transforming global finance. The Bretton Woods framework dissolved, ushering in a purely fiat era. Since then, U.S. debt and money supply have expanded exponentially. Supporters argue this flexibility prevents economic collapse. Critics warn it removes discipline from government spending. Over decades, inflation has reduced the dollar's purchasing power by over 95% compared to 1913 levels. What once required $1 now costs many times more. The shift away from sound money redefined wealth, credit, and economic growth for generations.
Yeah, I mean, this starts back last year when we were working on our prior documentary, which was about the SEC's war on crypto. That documentary project was called XRP Unleashed, also known as Rigged from the Start. And when I was looking at the monetary system and looking at the policies the U.S. government was deploying against these asset classes, I realized, well, if in every good story, the old adage, follow the money and you'll find the truth. And there's no bigger source of money than the Federal Reserve. So we had actually created a pretty compelling little introduction to the Federal Reserve that ultimately got cut from XRP Unleashed because that story ended up focusing on the SEC's inner workings and how we wanted to expose a couple of corrupt individuals at that organization. And so I was like, well, this is a great story, and there's so many people who have written incredible books on the story of the Federal Reserve, and there have been rumblings, in my day, in the 2008, financial collapse, the Occupy Wall Street people, you started to feel that wealth inequality really start to bubble into an intangible place, at least in modern context, at least for my generation. And so thinking back to that, you started to see the rise in certain anti-Federal Reserve candidates, people like Ron Paul. And so I think that all of that stuff started to enmesh in my mind. You kind of read something here, read something there, and you don't really put it together until you sort of start to think about what is the center of all of the financial woes that we have. And really, even the concept of sound money, I don't even think I had that in my mouth till a year ago. I started looking into this whole thing. And it's shocking to me because as I tried to hire people to work on this project, different people like even camera department, post-production, editors, it's shocking. A lot of those folks, even here in Los Angeles, were unwilling to work on the project because they thought I was creating propaganda. They're like, well, I don't want to end the Fed. And I said, wait, hold on. Do you understand what the Fed is? And they couldn't explain it. They said, oh, it's the federal government. I said, no, 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 no. Like, I'm not promoting anarchy. I do not want anarchy, right? W- The center of all of our financial trouble comes from the United States government's ability to print unlimited money, which really benefits the elite and doesn't do anything good for the average person. And that policy application, government, its third rail is always the application of money. So for me, I wanted to explain how the government really isn't funded by our taxes per se. It's funded by this unlimited money printer that was installed by the elite bankers in the turn of the century, turn of the 20th century, and how it has continuously been manipulated by various special interests, which is why lobbying is the most profitable business in America. You know, it's like you get a $27 return for a $1 investment. There's very few assets that you can do that in because you get the application of that money. And so looking at that cycle over and over, I knew that I needed to find the people who are the biggest voices in the various pockets of sound money principles. And so that was kind of when I got the idea last year for, okay, we need to get a whole story together on the Federal Reserve. And that started with my reading the book, The Creature of Jekyll Island,
Fabulous.
and expanded out to many others. So, yeah.
Monetary instability is not theoretical, it is historical. From the hyperinflation of Zimbabwe to the currency collapse in Venezuela, excessive money creation has repeatedly devastated economies. Even the United States has faced severe inflationary episodes, particularly in the 1970s. Periods of aggressive credit expansion often precede painful corrections. The Roaring '20s ended in the Great Depression. Easy money policies can create prosperity until they cannot. History shows that confidence, once broken, is difficult to restore. These precedents serve as cautionary tales in an era defined by record deficits and unprecedented global liquidity.
Yeah,
So-
I mean, arguably we could go fractional penny, right, as well, right? We could go below 1 cent, right? We could go to like it could get to a place where it requires, 100x what the 1913 equivalent would be, for any given asset, or any given, not even asset, just regular household goods. So yeah, we use the to your advice about the Fred, we use that as a major data source within the documentary. I mean, and we showcase CPI, Consumer Price Index, which is a more accurate indication of cost of goods and services, and we pull out the average cost of a house, the average cost of a car, and the average cost of a cup of coffee, and we use that as a price indicator at 3 different levels across time. With very few exceptions, you see that price, exponentially increase in each of those money printing sessions. We even looked at the house, the average price of a house in the 60s during the American Dream period, based on gold. How many ounces of gold would you need at that time? What was it, $45 an ounce or something to that effect? How many ounces of gold would you need to buy the house? And then what would those ounces of gold today buy you? And you can obviously see that gold has outstripped the inflation as a true store of value, and actually outpaces even home values. So it was something like the average home was, don't hold me these numbers, they're correct in the documentary, but I'm pulling them from memory right now.
Okay, that's
But-
fair enough.
But it was something like $16,000 was like the average house cost in 1963, something to that effect.
Mhm.
And it was something like, it was quite a lot of ounces. I was actually surprised because gold was so low in value at that time.
Yeah.
So it's maybe $35 or something.
35.
And so we looked at that in today's dollars, the number of ounces required, and it was the equivalent of $2.5 million worth of gold. If you hold those same number of ounces from purchasing the house in 1963 as you would in 2025, you would have $2.5 million. Well, average cost, it is increasing, but the average cost in America is in the mid 500s right now. And so you can see that you've outstripped that. The other thing I looked at was the S&P index, because everyone talks about how like, oh, index fund, Warren Buffett will say index fund, but if you take into consideration inflation, it's kind of interesting. The S&P doesn't look that great. It actually looks only like 5 or 6% better than it did like 40 years ago. It's just that inflation is so bad that, it kind of looks like it's constantly expanding. And
Right.
it is true. I mean, it's good to hold assets, and there are exceptions. There are some stocks, like we're in the AI bubble right now, right? That's the big thing. Like there are some stocks that do exponential growth based on their market sector or whatever. But as an aggregate, when you look at the whole beast of the S&P 500, it really isn't that much more valuable than it was, 40 years ago or so. So it's kind of interesting the games that are played with
Oh,
the cheap
totally.
money, and it doesn't actually amount to any real productivity, which is kind of crazy.
On paper, markets appear stronger than ever. The S&P 500 has multiplied over decades, and home prices in major cities have surged dramatically. But when adjusted for inflation, real gains are often less dramatic than headlines suggest. A house bought decades ago may sell for 10 times its original price, yet the purchasing power of that money has changed just as dramatically. Mortgages front-load interest, and transaction costs erode profits. What looks like wealth expansion may simply reflect currency dilution. In an inflationary system, nominal growth can mask stagnant real prosperity.
Yeah, I mean, I think home ownership, I mean, Robert Kiyosaki often is criticized, but I think is correct in that your house, especially in the first 15 years, if you're doing an average 30-year mortgage, your house is not really an asset, because by the time you add up all of the tax that you're going to pay and the fact that, just look at an amortization schedule for just a moment on a 30-year mortgage. They front load the interest. So it's a huge
Right.
con that you're buying this thing and then you're not really getting any equity out of it, because 80% of your payment, 20% is maybe going to taxes and home insurance and things like that, and maybe worse, PMI, if you have under 20% in there. And then the other, 70% of what's left is going towards interest. You're paying 10% on the principal or something. So it's a pretty outrageous game. And when people think, and this is kind of my mother's programming a lot as her generation, is like, you got to buy a house, you got to hold that asset. And I'm like, yeah, but your purchasing power hasn't changed. So if you look at what you could get and go selling your home now that has appreciation in it, you're not really anywhere different. Most of the time what people do is they end up just taking that dollar that they've earned. Let's say they're in a higher economic area, maybe they're in California, maybe they're in one of the coastal cities where Boston or New York Metro or whatever, where the costs are higher. They're taking that and they're moving to Georgia or Florida, where there's cheaper. They're not houses, and there always have been. They're not really getting any economic advantage within the economic zone that they're in, right? And so
Right.
that's kind of the big myth behind it. Is like, as soon as you sell that, you're going to have capital gains against it. You're going to have to pay your real estate agent 5.5%, and you're not really in a better buying power wise. You're not in a better place than you were. In
No.
fact, a lot of times you're upside down, because the area around you, if you look at, like, I looked at Boston Metro as an example.
As uncertainty grows, the debate turns to solutions. Advocates of sound money argue that assets with limited supply, such as gold, silver, and certain digital currencies, offer protection against systemic debasement. Gold, in particular, has preserved purchasing power across centuries of political and economic upheaval. Meanwhile, technological disruption from artificial intelligence and automation is reshaping labor markets, adding urgency to financial preparedness. The coming decade may test the resilience of fiat systems in unprecedented ways. Whether through reform or replacement, the global monetary framework appears poised for transformation, and those who understand it may be best positioned to adapt.